Welcome to another real estate industry update. I'm your host, Daniel Roccanti, here with Kyle Paxton. We are part of the real estate team here at James Moore and Company. And today we're going to talk about something that's very important to real estate investors, but I think it gets often overlooked how important it is. Most investors understand what this is, but it's basically depreciation. Okay. It's one of the big things that people like about real estate is I can purchase real estate and then take a deduction called depreciation for the purchase of that real estate over time. And depending on how you depreciate it, you could be able to take that deduction sooner than later and really front load some expenses here. But the question usually comes down to is what are the actual rules? What am I forced to capitalize? What can I deduct? If I do capitalize it, all right, what's the year? How many year life is it? Do I have to do it straight line? Can I do double declining balance? Which basically means you're going to depreciate it quicker. And then there's always the amazing bonus depreciation. Is it eligible for that? And there's a lot of questions about that. And basically what the IRS did is in 2013, they came out with these tangible property regs. This is their guideline to how we should be able to depreciate items, or can we expense them, deduct them, repairs more likely. And so when we get one of our real estate clients and they bring to us and they purchase a building and they improve it, we basically have to go through the tangible property regs and to determine how we expense it. If we capitalize it, how are we supposed to capitalize it? And as a real estate investor and as a taxpayer, this is important that you also know this information. Yes, your CPA should know all of this as well, but it's still important to you that you truly understand at least the fundamentals of what can be depreciated, needs to be capitalized, and then what can be expensed. Okay. It's always a great idea to know all this stuff. One, it helps you better understand your tax situations so that you can plan. And then two, when you get your tax returns and you're talking to your CPA, you can basically already know, like, all right, what's the information they need? Why are they asking me these kind of questions? I made an improvement. Why are they asking me, is this an internal improvement or an external improvement? Why are they asking me if it's what components? Why is it important that I break out every single improvement as much as possible instead of just lumping it together? Because I don't know about Kyle, but when I see an improvement and it's just $500,000, one line item, it's okay, what is this improvement? Because if you lump it together as one line item, now I'm probably having to take it more of a conservative approach if I can't get a true breakout of those items, which lets me get to be a little bit more aggressive on the depreciation because I might be able to view each item differently than if I had to view it as a whole.
Yeah. And so to expand on that a little bit with depreciation and with the concepts we're talking about here, in almost all scenarios, the preference is to expense your expenditure in the current year if we can to mitigate your current year tax liability. If we can expense it, then it gets capitalized into the cost of the building, or you can expand this to all fixed assets you're buying for your business. And then there's planning strategies around how to optimize depreciation, when to best take depreciation to potentially offset other income. These expenditures that are capitalized and depreciated, we are really just playing with the time value of money and the timing of these deductions. So if you're taking accelerated depreciation early in the building's life, asset's life, whatever we're talking about, you would go and eventually sell that holding. You're going to recapture some depreciation as part of that gain you pick up at sale. And we do a lot of planning around, okay, again, usually preference is expense. Can we expense it? If capitalized, what does that look like? How do we capitalize it? When do we take the deduction? Things like that. And so we have a lot of strategies at our disposal to time that. And it's especially beneficial for real estate professionals. I know the first time Trump was in office, his 4 years, I got the question pretty much every day, why do I pay tax and Donald Trump doesn't? And the big thing is depreciation on real estate. Right? So we play around with that a lot to try to optimize that for our clients. Um, and the governing framework of what we're talking about here is really the tangible property regulations, as Daniel was talking about. And these were finalized in 2023. So a lot of these concepts aren't new. A lot of the limits, things we look at, change over year, and we'll talk about that a little bit more. But the general concepts here have been in place for a long time. And so ultimately, the tangible property regulations cover what can we expense immediately versus what needs to be capitalized. And then there's a framework that oversees that called the BAR test: betterment, adaptation, or restoration. Betterment is, and these are things, okay, if your improvements fall into one of these buckets, we need to capitalize them and depreciate them. So betterment is, was the property improved to make it better than its original condition? Adaptation, are we changing the use of that improvement or the property in which we're improving? And restoration, did the work restore this property after some sort of casualty, or did it bring it back to that new condition? At a high level, we're just really looking for, are we extending the useful life of the property in a meaningful way? And if so, generally those types of improvements are capitalized.
Yeah, what Kyle's kind of saying about this bar test here, it's really about improvement once the building has been placed in service. Most people understand the concept that if I purchase a building, that has to get capitalized. Okay. For conservative reasons, usually when you purchase a building, if it's commercial, you have to depreciate it over 39 years. If it's residential, it's over 27 and a half years. That's a
That's a
long
long
time.
time. Yeah,
It's a
it's a
long
long
time.
time.
You're getting a deduction, but you're not getting a huge deduction. Okay. And so the Kyle mentioned this before, but the priority is we always want to expense something if we can. And if we have to capitalize it, then we want to take as much depreciation as quickly as possible. So we want something with a lower life and a quicker depreciation, basically. And so we're going across that priority. All right, can we expense it? All right, okay, we can't expense it. All right, we have to depreciate it. I'd rather depreciate something over 15 years than over 39 years. Can I do that? Okay, what's the rules say? So that's what we're going into. And so what these tangible property regs is a lot more about what improvements. Okay, I already bought the building. Now I've improved the building or I've done repairs. Okay. And they created this bar test. You've also might have heard his rabbi test too, if you're really into the details. Basically the same thing.
Getting too
It's
nerdy on us, Daniel.
we are getting too nerdy on this. But the key concept here is if it meets one of these, then it most likely needs to be capitalized and it can't be expense. Okay. Is it a betterment? Is it adaptation? Or is it a restoration of the property? Okay. And you can get really into detail there, but at the end of the day, it's just, are you making the property better, more valuable? Okay. Or are you doing some kind of significant restoration to maintain the value of it? This is like a roof. Okay. You got to get a new roof every year. If you have a long term deferred maintenance on properties, okay, and you don't do what you're supposed to do to your property, it will lose value over time. So you are required to do certain things to keep and maintain that value by restoration. This isn't necessarily turnover, okay? Like just replacing carpet and things. These are truly structural, fundamental things to keep the value if you don't do it, usually really big items. And adaptation is just if you are going to change the use of the property, usually find a new use for it, okay? So this is if I buy a property, it was office space, because as we all know, office space, there's plenty of it right now, okay? And so they're trying to find new uses for it. And if I'm able to turn it into a multifamily apartment complex, that's an adaptation, okay? I completely changed the use on it, and all those improvements are probably going to have to be capitalized, all right? So if it fits in one of those three categories, then of these improvements, then I got to consider capitalizing it. But it goes even beyond that. They bring into this whole conversation unit of property. Okay. And this is going to get really complex, so I'm going to keep this kind of short and simple. But basically, you have to do this test for each unit of property. So not necessarily does it always have to be the entire building and every single improvement, but there is unit of properties. This is like HVAC, plumbing, electrical, security systems, things like that. These are each different unit of property. And then you would do this test on each unit to decide if it needs to be capitalized. So this actually is in your favor. This is why breaking out your improvements as much as possible, because we're able to take these units of properties and decide how it's going to be capitalized. If you consolidate it all together, now we have to do it from a very high level. And it's just, okay, improvements on the buildings. All right, now it's one unit of property. That's what it looks like to us, okay? When really it could be a lot of individual units of property. And
Add on to Daniel, since we see it a lot. There's a bucket for other structural components too. So even roof, flooring, walls, things like that are the separate units of property we're talking about here. So really, just taking the building and breaking it down into each chunk of what makes up it.
so like the building, the whole building is like one unit of property, and then inside the building you're going to have multiple units of properties.
Right.
And basically we're taking each improvement in the unit of property, and there's actually 9 building systems that they define as unit of properties.
You
Already
nailed it. I
mentioned.
think you hit 7 of them. So
So
you're
yeah,
somewhere thereabouts. Yeah.
there's a lot,
Yeah.
and you can take each individual one and then take this test.
Yeah.
But as we know, there is a lot of things that we do that improvements that, are on the small side.
Yeah.
Okay. And it's not really worth our time to go in here and take this whole huge test and say, is it a betterment? Is it adaptation? Is it restoration? So the tangible property regs basically created these safe harbors. Okay. And there's a couple main ones that we want to go over. The one that everyone gets is de minimis safe harbor. All right. What that just means is that, hey, if this item is $2,500 or less, then you can just expense it. You don't even need to do this test. You don't need to decide if it's an improvement. You don't need to decide anything. Just expense it, which is very nice of the IRS. And this goes even beyond just buildings and things. This is if I buy a computer, I don't have to capitalize it anymore. I can do it under that. If you get financial statements, like audited financial statements under GAAP rules, basically, then that limit goes up to 5,000. Okay, which is nice. So all this small improvement stuff, we don't need to sit here and decide, is it truly a repair? Is it truly an improvement? We can just expense it. Another key reason why breaking out your improvements is important, because we might be able to use de minimis on each line item that's under 2,500 instead of grouping it all together, and then it's over 2,500 and now we can't use that number anymore.
Yeah, and the one here we see a lot, I'm going to use multifamily for an example, right? And you see a batch of appliances purchased, we'll say 50 grand for new washers and dryers, right? Each individual unit is below $2,500 in cost. And so we apply the de minimis safe harbor in most instances in that example to expense those fixed asset additions, since each unit and invoice is under the $2,500 threshold there. And so that's an example of something we see quite often, where in total the purchase was significant, but then when you're looking at, okay, what was actually purchased here, each individual item falls below those thresholds and can be expensed.
Correct. So a lot of times, real estate, especially multifamily, anything like that, they're buying in bulk. Okay, they're buying tons of washers and dryers at a time. It's important to be like, all right, how many washer and dryers did I buy, so we can break it down and use the de minimis. Because like I said, if I see a $50,000 line item, now I'm like, all right, I know a washer and dryer is not $2,500. I purchased my own washer and dryers. Maybe you can get by like an
Some
AI
are,
washer.
some are.
Yeah, if you can buy like an AI bells and whistles washer and dryer, maybe, but I doubt we're buying those for our multifamily apartment complexes. And so it's just important to have that information. This is why knowing these rules is important, because then you can enter it in your system correctly. I purchased 100 washers and dryers. Simple math tells us it's under 2,500. We can expense it all. We don't even need the line item from that afterwards. The other safe harbor that is probably the most important one comes to the routine maintenance safe harbor. Okay, this one comes up a lot, and basically what it says is if you expect to replace it, repair it, like 10 years or less, then you might be able to expense it. Okay, so why is this important? Because really, this is it a repair, or am I having to capitalize it? Repairs are usually expensed. Okay, is this an improvement? So if I have something like an HVAC or something, and I say I have an apartment complex right next to the ocean, okay, and even though HVACs usually should last more than 10 years because it's right next to the ocean, all the salt and everything, I'm having to replace this thing every 5 years. Okay. Now we can look and just see, hey, maybe we can repair it, see it as a repair, it's expense, instead of having to truly capitalize the HVAC every year or every 5 years or whatever. This is even better when we think about turnover. So if I have a multifamily apartment complex, I'm going to have turnover every time a tenant leaves. All right. I have to replace the carpet. I have to paint the walls. I have to do everything to get it back to the place where I can truly rent it again. Okay. Under this routine safe harbor and everything, maintenance safe harbor, this is easily tells us that we can just expense everything. All right. We don't have to go and do this whole test. Did we truly restore, or is this just part of the operating? All right. So this is why this is important, because this kind of gives us that safe harbor where we don't have to put a test on everything. We know in our heads when a tenant leaves, we just have things we have to do every
Yeah.
year or every time the
New
tenant leaves.
carpets every time.
Yes. And it really shouldn't be that way. You're not
Yeah.
improving the property.
Right.
You're not really restoring the value. It's just, this is what I have to do to make it rentable again.
And so with multifamily, sticking on that example, we're really generally looking at the exterior improvement, structural, pool, things like that are really adding value and into one of those, into that BAR test. Otherwise, a lot of it's just that turnover type activity, and we're able to deduct it in the year that it's incurred. The last, I'm going to go through this pretty quickly here, but the last safe harbor falling under this umbrella here is the small taxpayer safe harbor. And so for properties that have a cost basis under $1 million and you have gross receipts under 10 million for the last 3 years, you can elect to expense the lesser of $10,000 or 2% of the building's cost annually. And this applies to, it falls in the same line of thinking here to where this just gives you the permission that, okay, if I'm repairing a building and it's an insignificant portion of that unit of property that I am repairing, it gives you the permission to take that expense without going through all of these other tests. So that's one that we apply in certain situations as well. Again, it really applies to small taxpayers, but it falls under the
I think
same
the
one.
important thing here is it's small properties.
Yeah.
Okay. The basis has to be under $1 million. So really this is, do you own a lot of single family homes, small properties or whatever? If you're buying multifamily, if you're buying a commercial properties, you're usually not going to do this. So this is really just a safe harbor for like people that own single family rentals, a few. They can use this safe harbor so that again they don't have to go through the capitalized test. Hey, I got to put a new repair in. I might be able to just expense it, a new HVAC under these rules. So it's just another safe harbor. And they're just saying, hey, the smaller the property, these are usually for just small real estate investors. Mostly this is what this is for. Own a few properties, single family homes. They can a lot of times use this. Your big real estate investors going into big properties, you can, unfortunately, you won't be able to use this at all.
We don't apply this one too much in our day to day in our job here. At least I
No.
see it at three. All right, let's dive into depreciation real quick, Daniel. We're talking about accelerated depreciation and being able to front load deductions. We're playing with the time value of money. Generally speaking, I want my tax bill to be lower now than I do in 5 years. The one big way we can do that is push depreciation up, right? Two big concepts in this space, Section 179 and bonus depreciation. They do function fairly similarly in a lot of ways, and kind of which one we utilize more depends a little bit based on what the current tax law says. So the last 2 years or so, we've been in the land of 179. If one big beautiful bill eventually passes, we're recording this in June here and it's still floating around, percent bonus depreciation likely comes back. The utility of 179 on a broad scale comes down a little bit. But these two concepts both allow for up to 100% deduction on these improvements that we're talking about that we do have to capitalize. You have a comment on that before I dive in a little bit on some of the nuances?
Yeah, basically with Section 179, it's just another arrow in the quiver. Okay. Whether we're going to use it or not just depends on a lot of circumstances here. This is usually the last thing I want to use. Okay. It just is basically what it does is if you take Section 179, you are expensing the product, but it acts like bonus depreciation, like you're taking 100% depreciation. But there is strict limitations on this. Okay. Section 179 can only be used for improvements to non-residential buildings. So this is commercial properties. All right. There's also limitations. You can only deduct usually up to about, and this does increase slowly every year, but about 1,250,000. Okay, in eligible costs, and it does have a phase out. Once you have had improvements or purchases, and this is for fixed asset additions of over about $3 million, this starts phasing out and you can't take it anymore. So this again starts to eliminate a lot of really big taxpayers and really
Yeah.
big businesses.
And
Okay.
so the mechanics of that can be pretty ugly. Just to dive in on an example a little bit. So if you have $2 million of assets that you add that could be eligible for Section 179, like Daniel said, the 2025 cap is 1.25 million. So you can take Section 179 on $1.25 million, and then the excess could still be eligible for bonus depreciation depending on what that asset is. And so I'm preparing a lot of 2024 tax returns right now. What we saw was the bonus depreciation limit was 60% in 2024. So what we're seeing there is I can take 179 on the 1.25 million. Generally speaking, we want to utilize that on some of our longer term assets that still qualify for 179, so we can accelerate that. And then the balance there of 750K, just using rounded numbers here, is eligible for bonus depreciation, of which we got a 60% cost recovery in year one. So these can be weird when bonus isn't at 100%. There can be interplays that make this a little tricky, but as Daniel said, 179 is generally less advantageous because there are more limitations. Besides the two we talked about, there's a business income limitation. So you can't create taxable losses in your business using Section 179. So if you have a tiered structure where this is flowing through a lot of entities, you have some issues there. There's issues with trusts. There's a whole number of things that 179 can cause headaches for. So generally speaking, my fingers are crossed. If we get 100% bonus depreciation back on every asset that's eligible for that, that's more beneficial than 179. And it saves me a lot of headaches as a tax preparer.
Yeah, the 179 can get really complicated. If you have passive investors in your real estate fund, then you're probably not going to use 179. It's really for only active people in the real estate and your trader business here. So we don't use this if we have any passive investors on our tax returns. And then it basically all passes through to the individual level. So you could be allowed it on the basically the business side, and it gets to the individual level and you can't be allowed it. So it gets really complicated. You got to know your taxpayer very well. So this is better for more real estate that is owned and operated by the owners. Okay, one or two owners. This is not for the big investment funds or things like that. But it does have some very unique planning things. Kyle mentioned bonus depreciation, okay? Bonus depreciation is just lets us take additional depreciation the first year it's placed in service for any property that has under 20 years life, okay? That's very important because when you buy a building, it's usually at 27 and a half for residential, 39 for non-residential, so it's not eligible for bonus. But certain items to commercial buildings like roofs and HVACs can still be take Section 179. So if I have a client, they're the only owner of the business and they have a lot of profits going on and they need to they replace the roof, it's a sizable. Conservatively, we would probably go in there and capitalize it over 39 years and they would get a small deduction. Now 179 gives us the option to go in there and take the full deduction in year one. But we need to make sure that we're doing proper planning and our due diligence to make sure that the taxpayer truly can take the deduction. Okay. The worst thing
We're
that happens
dancing around this a little bit. I'm sorry to cut you off, Daniel. I do want to emphasize some assets are only eligible for 179 to accelerate. Some assets are only eligible for bonus. So there is, again, this is more complicated than it needs to be truly, but there's a lot of interplay there and things we have to consider on how to maximize those deductions
right.
once placed in service.
And for 2025, bonus depreciation is only 40%. If the big beautiful bill passes and it goes back to 100%, this will make a lot of our jobs easier, but there's still a component in there of items that are not eligible for bonus but might be eligible for 179. So even if 100% bonus goes back, there's still planning out opportunities around that for specific real estate investors.
Absolutely.
In 2018, when the Tax Cuts and Jobs Act came out, they also created this one additional item I want to go over quickly called the qualified improvement property. Basically, what this did is if you made improvements to non-residential, so commercial buildings, okay, after it was placed in service, and it's really just interior improvements, okay, so it excludes structural work, it excludes elevators, anything like that, escalators, and excludes a lot of things, but it created a 15-year life property, which means this is eligible for bonus depreciation, okay? And so if you are truly doing improvements in your commercial building, all right, and it has nothing to do with the exterior, okay, you're basically just improving, you're doing a huge renovation, you're making it look nice on the inside, it could qualify all for QIP, or some of it could qualify, partial qualify for QIP. So this is another why it's important to be like, hey, I got this huge improvement, it's $500,000. Okay, what is this? Because we have to break out any of the structural improvements, anything like that. Because we take the QIP, now we get accelerated depreciation, and if 100% bonus comes back, you get to take the full deduction in the year you did the improvement.
It's good stuff. It's good stuff. All right, I think that wraps us up here.
Yeah, that kind of went
Take
over
us
the whole
home.
property rules today, and there's always a lot more to talk about, but thank you for tuning in today's episode. We hope you found our discussion insightful and valuable, and if you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight, tax strategies, and help you maximize your real estate investments. Until then, stay informed, stay proactive, and happy investing.
Thank you.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.